Hey there, and welcome. Today, we are going to pull back the curtain on one of the most powerful but honestly most misunderstood tools in the investing world, the index ETF. Now, I know that name sounds super complicated, but trust me, by the end of this, you'll see it's actually a beautifully simple idea. So let's dive right in.
So, let me just start with a question for you. You want to invest, right? You believe in the long-term growth of the economy. But how do you actually buy, well, the entire market? All of it? I mean, without spending months researching and then individually buying hundreds and hundreds of different stocks. It feels like it should be impossible, but that's the exact puzzle we're going to solve today.
And for so many of us, this is the big hurdle. Getting started with investing just feels complicated. It's this mountain of jargon and charts that seems overwhelming. You know you should be doing it, but figuring out that first step can feel like a total maze.
You know, the traditional way of investing was all about trying to find the next Amazon or the next Apple. And that meant spending endless hours digging through financial reports, trying to predict the future. It's really difficult. And frankly, even the pros who get paid millions to do it get it wrong most of the time. So that raises a pretty interesting question. What if the goal wasn't to try and beat the market, but just to be the market?
Well, there is a way, and it all starts with a really simple idea that I like to call the market's shopping list. This is the first piece of our puzzle, and it's all about understanding what an index is.
So, what on earth is a market index? Seriously, just think of it like a shopping list. But instead of bread and milk, this list has the names of the biggest, most important companies in the stock market. It's an official cheat sheet that gives you a snapshot of how a whole slice of the market is doing.
And you have totally heard these names before. The S&P 500, that's the shopping list for the 500 biggest companies in the US. The NASDAQ, that's a list that's packed with tech companies. And the Dow Jones, that's the classic one, tracking 30 huge, influential American corporations. These are basically the most famous shopping lists in the world.
And just to give you a sense of scale here, get this, the S&P 500 index, just that one list, is so massive that it represents about 80% of the entire US stock market's value. Think about that. If you follow that one list, you're pretty much following the heartbeat of the American economy. Okay, so we've got our shopping list. That's the index. But how in the world do you buy everything on that list without 1,000 clicks? Well, that brings us to the second piece of the puzzle, your all-in-one shopping basket, otherwise known as the ETF. And this is where the magic happens. An index ETF, that stands for Exchange Traded Fund, is a single thing you can buy in your brokerage account, just like a share of Apple stock. But when you buy one share of it, it's like you've hired a super efficient personal shopper who zips around and instantly buys every single item on that market shopping list for you. In one shot, you own a tiny piece of every single company on the index.
Let me just break that down, because it's so simple. Step 1. The index, like the S&P 500, is just the official list. Step 2. A company, an ETF provider, goes out and buys shares of all 500 of those companies. And then step 3, you just buy one share of their fund, the ETF. And boom, with that one click, you're a part owner of hundreds of the world's biggest companies. It's so elegant.
Now, this whole approach has a name. It's called passive investing. And the big idea here is that you're not trying to be a genius. You're not trying to pick winners or beat the market. You're just trying to own the market and get its returns. And as we're about to see, that very humble goal is incredibly powerful.
The benefits for you are just fantastic. Right off the bat, you get instant diversification. Your risk is spread out over hundreds of companies, so you're not putting all your eggs in one basket. It's also completely transparent. You can look up exactly what stocks the ETF owns any day of the week. It's dead simple to manage, and because the fund isn't constantly buying and selling, it's usually way more tax efficient too.
But maybe the most mind-blowing benefit is the cost. Because the ETF is just passively following a list and not paying a team of Wall Street analysts to guess which stocks will go up, the fees can be incredibly low. I'm talking as low as 0.03% a year. To put that in perspective, for every $1,000 you invest, you're paying just 30 cents in fees for the year. It's practically free.
So, when you put it all together, the simplicity, the diversification, the crazy low costs, that brings us to our final piece. Why this one simple idea has been a complete game changer for millions of everyday investors. It really all boils down to two totally different philosophies. You've got active investing on one side. That's the old school way of trying to be smarter than everyone else and beat the market. And then you've got passive investing with our index ETF, which has a much humbler goal, to just be the market by matching its performance.
And here's the kicker. This is the part that blows people's minds. Decades and decades of financial research have shown again and again that the vast majority of professional fund managers, the experts who are paid a fortune to beat the market, actually fail to do it over the long run. The simple, cheap strategy of just owning the index wins out most of the time.
So we really end up right back where we started. By taking the market's shopping list, the index, and putting it into an all-in-one basket, the ETF, you get a low-cost, diversified, and incredibly simple way to build wealth. Which leaves us with one last big question to think about. Is it possible that the simplest investing strategy is also the smartest?